Howdy, Wealth Builders. Billy Bob here, your host for Build Wealth Now News. And joining me today is our brilliant market analyst, Sarah. Sarah, welcome back.
Thanks, Billy Bob. Great to be here. And folks, before we dive into our special feature today, we've got a packed Market Pulse segment. Some major moves this week that every investor should have on their radar.
That's right, Sarah. Let's kick things off with the big geopolitical story. Tensions in the Strait of Hormuz. What's the situation?
So even with a ceasefire in place, we're seeing serious disruption. The U.S. has blockaded Iranian ports. Iran has seized and fired on ships, and traffic through this critical choke point, which handles about 20% of global oil supply, has dropped sharply. Some vessels are getting through, others are being turned back.
And for our viewers watching their portfolios,
energy prices are already feeling the pressure. When a key oil route gets shaky, it ripples out. Higher fuel costs, potential inflation spikes, volatility in transport and commodities. If you're holding energy stocks, you might see swings. If you're in sectors sensitive to input costs, like airlines or manufacturing, watch your margins. This is a classic geopolitical risk premium moment.
Got it. Keep an eye on energy, inflation, and volatility. Now, switching gears to big tech, Apple just announced a major leadership change. Walk us through that.
Huge news. Tim Cook, who's been CEO since 2011, will transition to executive chairman. John Ternus, currently Apple's senior VP of hardware engineering, steps in as CEO on September 1st, 2026. Cook stays on through the transition to ensure continuity.
Ternus is the hardware guy. Does that signal a shift in Apple's strategy?
That's the million-dollar question. Ternus has deep expertise in product development and supply chain, critical as Apple navigates AI integration, new form factors, and manufacturing diversification. Investors should watch. Does Apple double down on hardware innovation, accelerate services growth? The transition is orderly, but any shift in capital allocation or R&D focus could move the stock.
Speaking of big tech making moves, Amazon just jumped into the weight loss drug arena. What happened there?
Amazon launched a GLP-1 weight loss program through Amazon One Medical. Think virtual doctor visits, prescriptions, and home delivery, all bundled with prices starting as low as $25 per month with insurance. It's a full stack play, telehealth plus pharmacy plus logistics.
And the market reaction?
Immediate pressure on pure play digital health and biotech names. Shares of companies like Amgen and Him and Hers Health dipped. Amazon's scale and distribution network could reset expectations for pricing and access in this booming market. For investors, if you hold weight loss or digital health stocks, assess their moat. Can they compete with Amazon's ecosystem?
Meanwhile, Adobe's making a big AI push and rewarding shareholders. What's the story?
Two big moves. First, Adobe launched CX Enterprise, a new AI suite to help companies automate and personalize marketing. They're partnering with Amazon, Microsoft, OpenAI, and NVIDIA to ensure cross-platform compatibility. Second, with shares at a relative low, they announced a $25 billion share buyback.
So Adobe's betting big on AI integration and signaling confidence in their valuation.
Exactly. But the AI software race is heating up. Traditional players face pressure from nimble startups and tech giants. The buyback helps support the stock, but long-term, Adobe needs to prove its AI tools drive real revenue growth and defend its creative cloud dominance.
And finally, Intel surprised the market with a 15% jump. What drove that?
Strong AI-driven demand. Intel beat Q1 estimates and forecast Q2 revenue above expectations, fueled by server chips for AI workloads. They also highlighted progress in restructuring and key partnerships. It's a sign their turnaround plan may be gaining traction.
But they're still playing catch-up with NVIDIA and AMD, right?
Absolutely. Execution is everything now. Intel has the manufacturing footprint and enterprise relationships, but the AI chip market moves fast. Investors should compare Intel's roadmap, margins, and ecosystem against peers. This rally is encouraging, but it's a marathon, not a sprint.
Whew, that's a lot of moving parts. Sarah, what's the common thread for our viewers?
3 takeaways. Geopolitics matter. Hormuz tensions remind us that macro risks can override fundamentals overnight. Leadership transitions create uncertainty, but also opportunity to reassess strategy. AI is the new battleground. From chips to software to healthcare, companies integrating AI thoughtfully will separate winners from laggards.
Perfect segue, because today's special feature is all about a nation using strategic planning to position itself at the forefront of the next tech wave. Sarah, we're stepping outside our usual U.S. and international stock deep dives to talk about something that affects all of us as global investors. China's newly released 15th five-year plan for 2026 to 2030.
Yes, Billy Bob. Think of it like this. China isn't just reacting to markets, they're designing them. For 75 years, they've used these five-year plans to set national priorities, allocate subsidies, grant permits, and even tie government officials' promotions to hitting specific targets. When the Chinese government picks a sector to back, it pours fuel on the fire.
So it's like the ultimate venture capitalist, but with the power of an entire nation behind it.
That's a great way to put it. And the results speak for themselves. Remember when made in China meant cheap, low-quality goods? Fast forward to today. China leads in EVs, 5G, drones, and now AI. Companies like SMIC are supplying chips to Qualcomm and Broadcom. That didn't happen by accident. It happened because of targeted policies in earlier five-year plans.
Okay, so what's new in this 2026 to 2030 plan? What's China betting on next?
Great question. There are four big pillars. One, modernization over pure R&D. China's shifting from inventing tech to scaling it. Think mass-producing humanoid robots, rolling out self-driving car infrastructure, or deploying AI across industries. It's about implementation now. Two, self-reliance through AI. After U.S. export bans on advanced chips, China is doubling down on building its own tech stack, with AI as the engine. Open access models like DeepSeek, that's part of the strategy. Three, new quality productive forces. That's the buzzword of the plan. It means emerging industries, biomanufacturing, 6G, green hydrogen, brain-computer interfaces, advanced medical tech. They even set a KPI, increase high-value innovation patents from 16 to 22 per 10,000 people by 2030. Four, strategic opening to foreign investment. Here's the twist. While pushing self-reliance, China is selectively opening doors. Telecom services, healthcare, biotech, and education are now more accessible to foreign firms. But it's controlled. They're curating who gets in.
So for our viewers watching from Texas or Toronto, what's the takeaway? Should they be buying Chinese stocks tomorrow?
Not so fast, Billy Bob. We're not giving financial advice, but here's how to think about it. Follow the policy tailwinds. When China prioritizes a sector, companies in that space get subsidies, fast-tracked permits, and infrastructure support. That's a powerful catalyst. Watch the implementation phase. Companies that can scale AI, robotics, or green tech in China's massive domestic market could see explosive growth. Foreign investors. The selective opening in healthcare or biotech could create opportunities for global firms with the right partnerships, but expect competition from well-funded domestic champions. Diversification matters. China's plan also highlights risks: aging population, geopolitical tensions, property sector weakness. No single country bet is without risk.
I love that. It's not about chasing headlines. It's about understanding the engine behind the growth. And Sarah, you mentioned a custom screener in the article for these emerging industries.
Yes, Simply Wall Street built a tool to filter companies in those new quality productive forces sectors with strong fundamentals. But the key is doing your own research. Check valuations, management, competitive moats. Policy support is a tailwind, not a guarantee.
Wise words. Before we wrap, Sarah, any final thought for our Build Wealth Now community?
Just this. The most successful investors don't just watch markets, they understand the forces shaping them. China's five-year plan is one of those forces. Whether you're bullish or cautious, staying informed helps you spot opportunities and risks early. And that's how you build wealth that lasts.
Couldn't have said it better myself. All right, wealth builders, that's our special deep dive on China's next winners. If you found this valuable, smash that like button, subscribe, and ring the bell so you never miss an episode. Drop a comment below. Are you watching China's tech rise? Which sectors intrigue you most?
And remember, this is for educational purposes only. Always do your own due diligence or consult a financial advisor.
Until next time, stay curious, stay diversified, and keep building that wealth. I'm Billy Bob.
And I'm Sarah.
Build Wealth Now. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This video is done for educational purpose only.